Welcome back to another weekly episode. So the comment section is open. Make sure your comments come in today. That is on Saturday. I'll reply to all the queries that come in today. Last week's Instagram DMs all have been answered. So in case you cannot discuss something with me on the comment section, you can directly contact me on Instagram. Give me a couple of weeks. I'll definitely answer your queries. And do keep the notification button on because in general, will never recommend my videos. So today's topic is about analyzing the strength of market bottom, or in other words, how strong is the current rally in the market, and how do you use the rules taught by William O'Neill and Stan Weinstein to determine the probability of the bottom that was recently made in the market and to assess the strength of the undergoing rally. So again, we'll be starting with the simple framework that has already been discussed by Stan Weinstein and William O'Neill. And of course, this is my understanding of that particular framework. That is what I've put across. And of course, everything will be backed by relevant data points. So the first is market correction or rally. That is determining whether the ongoing price action in the market is still corrective in nature or whether this is a start of a sustainable rally in the market. See, this particular point about market correction or rally, this I have covered in last week's episode. I've done a detailed video about it. I'll link it up here. Just in case some of you are coming to this channel for the first time, do watch that video also. You'll understand the relevance of it. I'll come to the point 2, 3, and 4. The first is define a probable bottom. That is first step. See, defining a level is important in assessing whether it could be the final bottom in the market. This is important because all further analysis that will be done, it will be done with respect to the level that you mark on the chart as a probable bottom. The third step is the 4th to 15th day rule. This is a rule that is taught by William O'Neill, and this is called as a follow-through day in the market. Now, I've slightly tweaked these rules based on what I have seen on a historic basis, but 99% it is the replica of what William O'Neill taught in his book, How to Make Money in Stocks. In this particular rule, you need to see what happens between day 0 to day 15th of you marking a probable bottom on the chart. Again, I'll come to this in a bit. I'll explain all of this in detail. The last step is evaluating the leadership in the market. After the follow through day has been confirmed by the market, you need to see whether the strong price action is backed by leading growth stocks that have sound fundamentals and breakout patterns. And then you have to assess this further as and when price action develops. So each of these 3 points I'll be covering in detail. The first is defining a bottom in the market. How do you define a bottom in the market? A probable bottom in the market is a level from where you see a broad-based recovery in the market. Sectors that were falling less continue to hold their leadership, whereas sectors that fell the most see a V-shaped recovery in the market. In recent times, now I'll open up the chart of Nifty 500. This is a probable bottom in the market that we saw 3rd of March, 3rd and 4th mainly. So this will become day 0. This is day 1, day 2, day 3, day 4, day 5, day 6, day 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. I've just numbered this because as we cover the rules, it will be easier for you to grasp the concept. So remember, March 3rd and 4th is a probable bottom in the market that is defined as per step 2. Now we will move to the third step, which is the 4th to 15th day rule that is covered by William O'Neill in the follow through day concept. So let us now visit the rules that is for day 4th and 15th, that is price, volume, and leadership. Again, these rules are taught by William O'Neill, the follow through day concept. In case you have read his book, How to Make Money in Stocks, this is something that you should be aware of. I'll flip through Nifty 500 chart also so that you can understand this concept well. Day 0 to day 4th. Day 0 is the probable bottom in the market. Between day 0 and day 5, price should exhibit some potential strength on the upside. If you look at the chart, if this is day 0, March 3rd, 1, 2, 3, 4, 5. Within these 5 sessions, you clearly see one strong candle here, which is follow through day. You have volume, which is greater than the previous session. So this was the first follow through day on the chart. The second is between day 4th and day 10th. Once the market has shown some signs of moving up, it ideally should not violate the low of the first rally day. Plus, price should print more wide range candles backed by volume. This rule states that this particular low point of the candle, this becomes a low that the market should not violate. That is when you can classify this as a follow through day in the market. And between day 0 to day 15th, you should be getting a couple of wide range candles on back of strong volume activity. So this is day 0, day 1, day 2. Then you have 3, 4, 5, 6, 7, 8, 9. And on 10th day, that is between day 0 and 10th, you get a strong wide range candle with a gap expansion in volume activity. And look at how price began moving up. Look at the spike in volume activity. This was a chart I had shared on my Instagram profile also when price was moving up. I hope some of you took note of it. So day 4th and day 10th is that it should not violate the low of the first day rally. And second, wide range candles backed by volume. Now day 10th and 15th. See, many a times it happens that on day 10th, the rally may not come, and it may also not come between day 8 and day 15. If it comes on day 16th or 17th, that rally as a weak rally, because rules are pretty clear. Between day 0 and 15th, you should get couple of wide range candles on back of strong volume activity. The last is leadership. Assessment of day 0 to day 15th concludes with the leadership in the market. What is leading the market? Post initial rally is the leadership sustaining its structure. This is a completely different slide that I'll cover. So the rules I'll explain in a bit. But I hope this part is clear. Why marking it as day 0 is important, and why then assessing the price action of that particular broader market index. This only has to be attempted on something like S&P 500 or Nasdaq 100 or CNX 500 Nifty or Nifty total market index. That is when you will get a broad based idea of what is happening in the market. I've also read a couple of things about follow through day in William O'Neill's book, where he states that this is not a method that cannot fail. There is no method in the market that cannot fail. And many a times he has highlighted how after this first follow through day candle, price just rolls over and hits a new bottom. So this is something he has explicitly mentioned in his book, that this is not a method to say whether the market bottom is formed or not. It's a method that helps you in anticipating whether a market bottom is formed. And number two, helps you identify the potential strength of the bottom in the market. So now that we have covered the define a probable bottom step and the step about the 4th to 15-day rule, we'll now move to evaluating leadership in the market. This again is a critical step. So while evaluating leadership, there are 4 points that I need to track. First, relative strength. What fell the least during market correction? Such sectors have high relative strength. In our context, it was banks, finance, metals, hotels, chemical, fertilizer. There is some tourism stocks also, but I've mainly included the major sectors in the market. The next is 4th to 10th day. Did the sectors with high relative strength lead the market recovery between day 0 and day 15? If yes, then this is a confirmed leadership in the market. In the last couple of episodes, even in January when the markets were correcting, this is a message that I had repeated many times, that banks, finance, and metals, these are the 3 pockets in the market that are resisting to fall. They are trying to form a bottom and trying to move up. So the signs were clear from January itself. It was just that because the sentiment was so damaged, that everything looks as though they are heading down, because there is a recency bias that always traders and investors suffer from. So again, 4 to 10 day, open up the chart and see which sectors were trying to move up. The answer is pretty clear. Consolidation. Post recovery, that is between 10th and 15th day, have the sectors, the defined leadership sectors, given up their gains? Are they retracing on back of higher volume? Are they forming wide range bearish candles on back of volume? Or are they simply consolidating and pulling back on lower volume? Open up the chart of Bank Nifty, Nifty Metal, Nifty Finance. It's very easy to get the volume of these indices. You simply have to club in all the stocks that are there in banking sector defined by NSE and just add up their volume and see what was happening. Banks, metals, finance, they were consolidating on back of low volume. No wide range candle on the downside. Then the volatility. After recovery, which pockets are more volatile? The ones that exhibited leadership, that is the ones that had high relative strength, or the ones that had V-shaped recovery after falling the most during the corrective cycle. In the last 5 days, take up something like a ATR indicator, that is average true range over the last 10-15 days. Compare with the rest of the market and compare with banks, finance, and metals. Again, the answer will be pretty clear. I'll just sum up that chart for you. In this particular chart, the green line is the banks, metal is the yellow one, finance is the blue one. The total market without banks, metals, and finance is the red line. So post November, you started seeing a decline in total market. This total market again is X the leadership in the market, which is X metals, X finance, X banks. All right. So you see everything move together on the downside between November and December. And then you saw first metal started bottoming out, then finance, and then bank. Now, if you look at it between March and March 20th, last 15 odd days after the initial run up, this is a relative performance chart. This is not a price chart, so don't get confused. You're seeing that banks, finance, and metals are retaining the leadership while performing relatively better. If you look at the total market index, the fall was steep and the recovery still is not that great. So if you go back to this rule, evaluating leadership, this means between day 4th and 15th, it is the leadership pocket of the market that has moved up. And now, when the price is consolidating, probably waiting for the tariff news that's going to come out, because that is the new talking point in the market, these pockets of leadership are still sustaining their relative outperformance. Whereas in the broader market, the recovery was just about okay, but the retracement is sharper when you compare it with banks, finance, and metals. Of course, there are a lot of industries here. I'm not taking the names of those industries, I'm just sticking with the major sectors in the market. So, banks, public and private, finance, financial services, capital market, metals, and commodities, and the total market index without inclusion of banks, capital markets, finance, because then that would distort the data. So leaders have moved up with strength and they are now consolidating. This is a big positive sign in the market. So now that we have completed all the rules as taught by William O'Neill and Stan Weinstein, how would you assess what is going on today in the market? So my assessment states that while the recovery from lows is really good, it is still selective in nature. Recovery is on back of banks, metals, finance, and some other key industries in the market. Bottom is made in these strength pockets, but for the rest of the market, lot of work needs to be done. For weaker pockets, one cannot be sure still whether bottom is made or not. Focus should remain on sectors exhibiting strength, as any pullback due to tariff news would further improve risk reward in these pockets. Also, keep a tab on number of stocks above 50 and 200 DMA. Data is still concerning. So I'll just elaborate on this. See, while banks, metals, and finance has done exceptionally well relatively and has taken the market higher, you have to take into account that the broader market is still struggling. So, based on William O'Neill's teaching, you can definitely say that banks, metals, finance, these three pockets, and some other sectors also have indeed bottom out. It's going to be very difficult for the low to be breached in banks, metals, finance because of the kind of run up they have seen. They are sustaining above 50 DMA, 200 DMA, which is again a positive sign. So, based on his teaching and assessment of strength and leadership, you can make this assessment. But for the broader market, maybe the SMID space, that is small, mid, micro cap space, and a lot of sectors that still remain in the bottom performing list, you cannot be sure whether the bottom is made or not. And rightly so. Rightly so, because whatever talking point exists about the Trump tariff that is going to come out in April, it is of relevance. It is of relevance because historically, whenever there has been reciprocal tariff or when countries retaliate against a country putting tariffs, that has never ended well for the particular economies and the stock market in general. So we are still in a very selective stock picking in strong sector kind of a market. We still haven't bottomed out when it comes to the broader market. As of recording, there are just about 16% stocks that are above 200 DMA. There are just about 29 or 30% stocks that are above 50 DMA. This is not a healthy indicator. So the health pocket in the market is these three segments. So let's say some nasty news comes out of Trump tariff or the global market starts cracking big time. And you got to look at these sectors. You got to look at these pockets to see if you like something. Again, it's not an investment advice. You need to consult your investment advisor for this. But at least that is what something that the market is suggesting in terms of the rules William O'Neill has taught. Whereas rest of the pockets that remain really weak I wouldn't be interested until and unless I see broader market improvement happening. Broader market improvement means stocks moving above 50 DMA, 200 DMA, and sustaining above it. Stocks that are forming higher high, higher low structure, sectors that are forming higher high, higher low structure above 50 and 200 DMA. That is what tells you that the market is sound. That is what tells you that the strength of bottom or the strength of the existing rally is something that you can determine with a lot of certainty. So we are still not there yet. We have to see what kind of news comes out from the US. That is something that you cannot ignore. The Trump tariff, it is going to be a tactic to negotiate, then that is a different story altogether. But you're already seeing a lot of things happening in Europe which are not great for the entire world. You're seeing the divergence of relationship between the United States and the European Union. And you're seeing that the European Union is strongly standing behind Ukraine. And you can see a lot of things coming out of European Union on a day-to-day basis about what is going on between Ukraine and Russia. So this is a developing kind of scenario, and I think probably the market is reflecting this in a way that the broader market recovery still remains relatively weak. So we would have a better assessment probably next week once the tariff news is announced. If you go back to the 2016, 17, 18 cycle when President Trump did this, you saw that the broader market took a lot of time to recover, whereas the strength pockets of the market, every time they would fluctuate, remain volatile, and give you buying opportunities. So probably that is the kind of market that is emerging today also. If the tariffs are temporary in nature, if the tariffs are something that is used as a negotiation tool, then we'll be fine on the broader market level also. But if the tariffs are serious in terms of implementation, in terms of this divisive kind of world that is emerging, then this is the kind of market that will remain. That is, strength pockets would do well. Periodically, you will see fluctuation and volatility, which will give you a great buying opportunity, whereas the broader market will continue to struggle. So this is a sticky kind of a market. And of course, I'll revisit this framework couple of weeks down the line just to assess what is happening with these strength pockets, because currently there are a lot of traders who are focusing on these pockets. And typically when short term focus remains on 2 3 spaces in the market, the risk reward is never great. That is where we are. So I'll see you again next week, guys. Take care, be safe, and make sure your comments come in today itself. That is on Saturday. That is when I'll answer all the comments. So take care, be safe, and have a great weekend ahead.